B. Prasanna is the Group Head Global Markets at ICICI Bank and now joins us live. Thank you so much for taking time out. Perhaps I'll begin with the talking point that we have across the globe. And, finally, we have seen some reprieve coming in for the US equity markets. And I think there's that widely anticipated interest rate cut later on this meet in September from the US Fed that could potentially assuage concerns when it comes to the weakening economy. It wasn't too long ago that we were talking about these recessionary fears really looming large and everyone was sort of hitting the panic button. Do you think that those were perhaps a little bit unfounded earlier? And what would be your outlook on where we stand right now on the recessionary concerns and what the Fed could do?
Yeah, so I think we do feel that I think the recessionary concerns as far as the US is concerned is kind of overblown in the markets. And markets kind of find a way to justify what happened in the market through some kind of an economic narrative, which they create then. So our feeling has been that I think the Fed has achieved a soft landing kind of a scenario. I mean, that is based on the data that we are seeing as of now. And the rate cuts that we are going to be seeing from the Fed going forward is into a slowing economy rather than a recession kind of an economy. Of course, we will have to, look at how the labor data as well as inflation data for the next 2-3 months and the production manufacturing data comes out over the next 2-3 months. But as of now, I don't think there is anything for us to believe that there is a kind of a recessionary fear. And I do think that the Fed will cut rates starting September, but it is pretty much into a slowing economy rather than into a more alarming recession kind of an economy.
Yeah, sure. But the lead indicator of that, or at least the historical indicator, Mr. Prasanna, has been the inversion of the yield curve. And we have been inverted, at least in the US, for the last, I think, a couple of years or at least 12 months now. But earlier as well, when it turned positive and the inversion reversal happened, that is when we hit recession. Is that something that you think is likely to follow, or do you think we're in for a bit more soft landing?
No, so it's a little bit difficult to guess where we are going, but I would say that the yield curve as a recession indicator has not proved to be right many times in the past, or much more it's not really proved to be right recently. And one of the reasons has been the kind of the QE that has happened post the global financial crisis, where yields have been suppressed by the Fed buying a lot of bonds. So having said that, the fact that the yield curve has been inverted for the last 2 years and is just about corrected, but still pretty much the growth has been pretty good over the last 2 years, kind of gives you the feeling that yield curve inversion is not really a recession indicator. And like I said, I think a lot of things are going on the move as we speak. And one of the fears which is doing the rounds is that labor data, when it starts getting weak, kind of accelerates the weakening pressure very soon. And that is one of the reasons that market is trying to kind of maybe price in the fact that the last two labor data, while one of it really came weak, the other data didn't come as weak as what was feared. But nevertheless, market is expecting that what if the November and the December data comes out to be much weaker. The fact of the matter is that there are lesser and lesser job openings and there are more people who are competing for the same jobs. The ratio is coming down. So to that extent, I think the market is justified. But at the same time, whether we would actually lead to a recession kind of a scenario, I personally don't feel so.
Okay.
Hi, good morning. Nikunj also joining in. They say history is an indicator of what lies ahead, but I see a lot of historical correlations are suddenly getting broken. Dollar index going down, commodities not going up, yield curve inversion not indicating which way things would move. High bloated, deficits are not having impact on the economy per se. India, which has got the best growth, S&P and everybody says that we don't care, we will not change the rating upgrade. Why are these historical correlations not playing out this time?
Good morning, Nikunj. I think so. That's a great question. And I think that's the typical way markets typically react. I mean, they want to see the data that they want to see data the way they want to see it. And like, for example, for last 2 years, we have always been seeing that good economic news has sometimes been bad for the markets because you kind of, expect the Fed to hike rates. But in between, in the last 1 month, you actually saw that correlation itself breaking, where good economic news turned out to be good for the markets as well. And similarly, bad news also becoming bad for the markets. So right now, for example, if Fed were to cut 50 basis points, if you had to go with a narrative which has been turning out in the last, say, 1 year or 2 years, when an interest rate cut is going to start, you would expect it to be very positive for the markets, especially equity markets as well as bond markets. But at this point of time, there is a feeling that if the Fed is going to start with a 50, then is the Fed knowing something that the market doesn't know? And so there is likely to be some kind of a panic. So the best case scenario for markets right now is for a Goldilocks kind of reaction by the Fed as well as data. The market is hoping that they'll start with the 25 and feel the economy as we go along and then do it. And that is one of the reasons why correlation keeps breaking. And if it was so easy to just look at history and decide how the markets will react, then it will be a much easier job tracking markets. The beauty of the markets is you not only look at data, but you also look at how the data reacts with respect to market expectations. So I think that's critical as far as market variables are concerned, Nikunj.
Is Fed considering a rate cut because they think inflation has come under control, eventually it is headed towards the 2% mark, or they are now genuinely getting worried about which way the US economic growth could move in the second half of this year?
I think a bit of both, Nikunj. I think very clearly in the last, let's say, if you look at last 1 year data, last 6 months moving average and last 3 months moving average, inflation has been in a consistent lower trajectory. And the 3-month moving average is definitely leading you to believe that the incremental run rate of inflation is 2% or even lower. So there is definitely some comfort coming from that perspective as far as inflation is concerned. Now, with rates being at 5/4 to 5/2, now you can argue, even if you were not confident of achieving inflation at 2 at this point of time, does it need to be at 5/4? Because the real rates are going to be pretty high. So even from a real rate argument angle, I think the Fed is possibly sensing that it is time for them to start, because the rate cuts are also going to impact the markets with a lag. And it might be too late if they wait for 3 months, 4 months more, by which the Y-on-Y inflation might be closer to 2%. So I think they are shifting their stance a little bit, looking at, they have been looking more at inflation and less at growth data so far. But now going forward, they have starting to give importance to labor data. And another aspect is that so far they have been looking at the current inflation data. And now I think we will see a change that they will start looking at future data. And by that, I mean that they will start building in some kind of a cut in inflation as we go forward. And hence they can afford to cut even when inflation is higher than 2 at this point of time, because they expect labor data to come weak. They expect growth data to come weak, but not recessionary, mind you.
Appreciate your time. Thank you so much for giving us clarity on all that's happening when it comes to the macros. That's the take from B. Prasanna.
If you like this video, then like, share and subscribe to ET Now.